Hi, I'm Brian Douglas, the FICO Insider. Here are a few facts you should consider about the credit card companies, the interest rates they charge you, and what else they can do to you. A few years ago, the credit card industry successfully pushed through a new bankruptcy bill, which made a fresh start for people stuck in the worst financial situation of their lives significantly harder. Of course, many of these people are in that position because they should never have been given all those credit cards to begin with. But let's face it, the card company sets you up with killer deals, easy credit, and offers you simply could not refuse. The interest rates and fees have skyrocketed. At 18 to 24% interest or more, which is common on many cards, it can take you 7 to 15 years to pay off a $1,000 balance if all you do is simply pay the minimum payment. And that's assuming that you're never late or go over your limit, either of which can earn you a $35 penalty each. So if you're over your limit and you're a day late, make it $70 per month. See where I'm going here? It's a no-win situation. Read the fine print on your credit agreement carefully. In the past, if you were having problems with a creditor or two, you could focus on one or two cards to stay current with and maintain a good relationship. Now, most creditors routinely check your credit score, and if they see late payments on other accounts, they'll raise your interest rate, sometimes from your currently reasonable rate, if you have one, all the way to 18 to 24% or more. A single late payment or going over the limit could trigger the same result. Naturally, they'll approve the charge that puts you over your limit so they can raise your interest rate rather than declining it as they did in the past, preventing you from going over your limit. Yes, some of the laws have changed now, but watch carefully. The loopholes are pretty generous to the lenders. For example, SunTrust Bank will deny a charge that would take you over your limit on a personal card, but not on a business card. Go figure. A few years ago, legislation was introduced to give states the power to regulate and limit the practices and costs of credit cards. The legislation was opposed heavily by the credit card lobby and ultimately failed. Most banks continue to base operations out of Delaware or South Dakota, the two states that allow the highest interest rates and fees and the least amount of consumer protections. Other laws proposed and killed in recent years include provisions that would require minimum payment disclosures, like how long it will take to pay off your debt if you only pay the minimum payment, limiting interest rates, preventing bait-and-switch tactics in your credit card offers, protecting college kids, preventing a company from raising your interest rate or charging fees based on being late to another company. You name it, they'll find it, and they'll kill it. Don't you get just a warm and fuzzy feeling about all this? In one expose recently, Capital One Financial was revealed to keep customer credit limits low, but then they offer the most vulnerable borrowers additional cards instead, helping them dig ever deeper holes with penalties of hundreds of dollars a month. Classy, very classy. What's in your wallet? Hopefully not Capital One. To get the rest of the details about what to do about this madness and receive my free special report, The Great Credit Score Scam Revealed, visit CreditReboundInstitute.com.